And we're live. Good to see you guys. Good to see you guys. Today, we got a lot of fun things on the docket, okay? We are going to be talking about Ally stock. We are going to be talking about Discover Financial Services. We are going to be talking about some SoFi stock. Who would have thought of it, eh? And last but not least, we're going to be talking about some toast, maybe some burnt toast. That being said, I see a Tanner in here. Russell, good to see you. Jared, Doug. Hi, everyone. I'm going to mostly listen in while I grill some chicken on the barbecue. I'm looking forward to the show. Thank you, Doug. Usually Doug's a big contributor. Yeah, Tyson chicken? What are you buying? What stocks can we benefit from? Good to see everyone. Yeah, Tesla down almost 5%. I'm in that pain, but you know what? Great stock. Love it. Still looking forward to holding it. Okay. Yeah, you're the real Tanner. Okay. All right. Okay. Why don't we just jump into it, eh? Let's just jump into some Ally Financial. Boom. Okay. Ally had presented today during the morning hours. Discover Financial Services actually showed off their earnings later into the day. But that being said, I'm more focused on Ally as they're one of the largest digital banks here in America, much larger than SoFi. I think right now they have something along the lines, what is it, like a $30 billion market cap, something like this? Or actually, I think I'm thinking of a DFS, actually. Yeah, I'm probably thinking of DFS. Yeah, $9 billion market cap. Actually, that's so funny. SoFi is actually larger in terms of market cap, but not in terms of customer accounts or overall deposits or anything like this. But it's the future growth that people are paying for anyway. So let's talk about it. Bear with me really quick. I just need to transfer that over. Does it make a little chizzy change? Okay, there we go. Perfect. Okay, so there's a couple things that I want to show off instantly. And so why don't we actually go down and look at their customers? Okay, so I'm pretty sure if I remember correctly, this is on page, 17? Deposit and customer trends. The largest one, all digital direct US bank with 2.9 million Ally Bank deposit customers. SoFi is going to pass that really quickly. Eh? SoFi Money, already one of the fastest growing products at SoFi, with over 1 million plus customers growing at unbelievable rates. We'll pass that quite soon. And then, even the direct deposit customers of that amount are, 50% roughly. Unbelievable. So let's find some trends, see what they actually saw. 86,000 net new customers in Q2. I mean, if you're a SoFi person, you're like, okay, well, that's a cute number. That's cute. Which is actually quite a drop off from Q1, as you can see in this chart down below, right here on the bottom right. Now, what I did find interesting, I saw this chart whenever I was going through. I thought this was so interesting. The percentage, I'm actually blocking it, aren't I? Okay, how does this look? The percentage of multi-product relationships with customers has taken so long to grow. Now, Ally Financial, for the most part, is known for Ally Bank and then also lending out to auto finance. Okay, so it's a little bit different than SoFi as they kind of go after a different niche. SoFi got built up doing student loans, where Ally really got built up doing auto loans, and they really don't like to step on each other's toes. They kind of avoid that. That being said, SoFi's multi-product relationships is more like 50%, right? So that being said, it is much more interesting knowing, or I would actually say it's probably closer to 40%, just because there is so many people that have more than three plus products. But that being said, it's much higher than Ally, and that cross-sell ability is super strong for SoFi whenever you're trying to compare these two companies. So it's quite interesting. Now, they do talk about all of their other products right here, like Ally Invest, where you can see, it's just not growing. It's just not growing nearly as fast as what SoFi's Invest product is doing. kind of interesting, actually. I find that their cross-selling hasn't been quite interesting. We'll talk about Ally lending in a second, but let's drop off over at the Ally credit card, which has actually been growing quite strongly, 56% compounded annual growth rate since 2017. And we'll actually get into the actual numbers of how well they did. The reason why I find this interesting is I want to compare it to SoFi, because the one thing that I find people don't talk nearly enough about is the health of SoFi's credit cards. Their net charge-off rates, which is practically the amount of their loans in which they don't actually suspect that they're going to get that money back. It's kind of like a a little bit of a write-off, is very close to 20% over at SoFi. Very, very high. People don't know that most of the time. Whereas Ally credit card and these sorts of things, more about 8.5% roughly, but we'll look at that later. Much safer credit card, but that being said, it's not growing as fast. It is growing, but like, for example, in that same time frame, SoFi has practically 10x their credit cards in the last 2 years. But yeah. Ally lending, point of sale. So this is not their auto financing. This is nothing like this. This is a little bit interesting. This is almost similar to a buy now, pay later product. The only difference is it's for much larger purchases and with hard credit checks at the time of approval. Okay, so it's a little bit different. I don't really see the point of it. It is growing a little bit. But that being said, I don't think that that's the future. I think buy now, pay later is the future. And it's why I really don't put a lot of, sort of idea into looking into Ally. I just really don't like this company that much. I don't have a problem with them. They seem to be doing just fine. They're just very old school while trying to go after a very new market. Like they even talk about their, the ages in which they're growing in. It's, I think 60 something percentiles. Here, wait, let me find the actual page. Is it page 13 here? No, this is key metrics for charge-off rates. Okay, well, let's talk about this regardless. So the two companies that had actually reported their earnings today, Discover Financial Services and then also Ally Financial, showed a little bit different on, their overall like consolidated net charge-off rates. The drop here for Ally was actually quite exciting as a percent basis, right? Whenever we actually look at the actual activity here per products that they're looking into, a large drop in their retail auto. Ally lending actually went down a little bit, but you have to remember these are in the form of millions of dollars, not just percentiles. So it's not like Ally lending did actually grow. So it is actually getting better this quarter. But that being said, like whenever you look at this large ramp in Ally credit card, it's not actually that extreme whenever you consider the large growth in their credit cards this quarter regardless. That being said, the reason why I'm saying this is because we have to, whenever SoFi actually releases, we have to look at all of these different statistics whenever it comes to their lending, credit cards, all of their different numbers to make sure how healthy they actually are. And the reason why we're looking at Ally is to sort of see how is the industry going in general. Okay. There was a really cool part that I wanted to point out. Where is it? It is page 30 really quick. Their funding mix. This has been a big topic of conversation for SoFi as well. The large percentage of their actual funding comes from deposits. Now, SoFi is around 77% right now, but we just got it about a year ago, okay? Back in Q1 of 2022. So, yeah, it'll take a little bit to actually get to the 87%. That last little stretch will be a lot as we sort of, slow down the amount that we're grabbing from warehouse facilities. But let's talk about the deposit mix, as this is something that people don't bring up a lot, is that it's not just from straight people putting in deposits at SoFi. There's also retail certificate of deposits or retail CDs. This is something that makes up a large percentage of the deposits at Ally, about 27% this quarter. Just even at the lowest quarter here, 20%. SoFi doesn't even offer this yet. You know what I mean? So there's still so much growth that's to be done at SoFi where new products can come in and people can actually want or use these products. The reason why they maybe don't even offer it is just because we're offering such a high savings rate to begin with that, what are you going to set your retail CDs at? But that being said, it still is a very good product and something that we will get into, just maybe not right now. What else did I want to show off? Now, their mortgages is an extremely small part of their business, but what was interesting is that all of these quarters going, each quarter that passed, I'm covering, the direct-to-consumer originations were shrinking quarter after quarter after quarter. And then really at the bottom here, Q4, Q1, is whenever we acquired Wyndham Capital, which I think is so funny for SoFi, because then that little uptick that's starting to happen is showing a large improvement in the business. Now you can say, $200 million of originations to $300 million is not a ton, Tanner. I mean, it's a 50% improvement, but yeah, there is so much to go. There's a lot to go there, but still, it does show improvement in the market that a lot of these banks are starting to originate more and more. And SoFi has been ready with the Wyndham Capital acquisition to start originating more mortgages. So I'm quite excited about that. Now, let's dig into some other things that I also noticed for Ally Bank really quick, and then we'll move on. Oh, actually, I wanted to go back here. So this was just some supplemental information here in their key financials. And I just wanted to take a look at this to sort of see what some of these banks are looking at. Let me even zoom in one more time, as this is really what I'm looking at. Now, I want to break it down per product because obviously each business is individual. So, we can't just look at Ally Invest with their net funded accounts, which seemingly are not moving at all. Average customer trades actually going down, but yet net customer assets are going up, which essentially means people are holding for longer, which is quite cool. I mean, that's exciting. It means good things for SoFi if we see similar customer trends. However, SoFi is not as open in their customer, or at least in their data on their earnings presentations. So that's the one thing that I find with SoFi is like, for a lot of this data, you have to really go digging into their 10Qs to find this sort of information. And even then, like, we don't have this information at SoFi. You know what I mean? They just show off product numbers, which is not my favorite. Net charge-off rates for Ally Lending at 5.1%, when actually it was 5.8% last quarter. Quite interesting. I don't know if that's actually across the board in terms of industry. I mean, a lot of the banks actually reported it continuously going up, as well as Discover Financial Services. They also reported it going up, but still, it is quite interesting. Gross originations actually down though, just by a very tiny amount. Josh, thanks, my friend. Appreciate the $20. Thanks so much. Congratulations on your day, by the way. I think he just reported that his portfolio just hit like $2.3 million or something. Which, if I don't want to speak out of terms, but is it a SoFi specific portfolio, Josh? I remember it's a large part for sure. Thank you. Thank you. Credit cards here, though, however, growing like crazy from last quarter. Net charge-off rates only 8.5% on an annualized basis. Comparatively to SoFi, like I said, SoFi is more like 20%. More like 20%. Chris, Ally is a 45-year-old trying to fit in at the club with the 20-year-olds. Honestly, that is how I feel. That is exactly how I feel. They're doing things like the approach is similar, but it's not there. Like you could see the difference whenever you look at the newer companies like SoFi comparatively. Even SoFi does a lot of the older type things, like very much traditional banking, comparatively to a Cash App or something like that. Like that's very young. That's almost like then you're like a teen with a fake ID trying to sneak into the club. That's sort of the comparison there. Josh said 98% of his portfolio is SoFi. 98%. That made him a $2.3 million portfolio, for which this man donates like so much to this channel. Really do appreciate it, Josh. It's not what do you called? Needed, but greatly appreciated. So thank you so much. I do appreciate your support. Ally has lame commercials. Yeah, because they're trying to attract lame people. But that being said, they're much safer than the SoFi credit cards. And I love a company that grows a nice credit card business, and they seemingly are doing that. So quite interesting. Even compared to last year, it was only at 3.8%. Wow, to 8.5%. SoFi, very similar situation. We can also dive into that if you guys want. So let's see what actually, there's one last thing I want to show you guys here. Let me go back. As you can see, 14 plus year retail deposit growth. You can kind of see what can happen. I think there's a nice graphic that they have here for deposits over time. I'm going to pass it by doing that. Maybe I did pass it. Oh no. There it is. There it is. Okay. This just sort of shows that that cohort growth over time. Each color here stacking on the sands is all the years that the depositors have sort of put in their money. And there's been dips over time where the overall amount of people have dipped during certain areas, but overall it is a growing deposit base through cohorts that stick up over time, right? 2.9 million retail deposit customers, 92% of them are FDIC insured. SoFi is more like 97%, and that's not because we don't have as good of clients, but it is because our FDIC insurance goes up to $2 million. Average customer deposit balance, $50,000. I'm sure that's higher than SoFi's, but that also comes with age. We'll get that as well, ladies and gentlemen. But let me go back really quick. So, okay, wait, let me go back to page 17. Yeah, as you can see, $140 billion of deposits is exactly where I think SoFi is heading to. I don't think there's going to be a slowdown in deposit growth. Fintech is the future. What we do want to see better for SoFi, though, is net new customers coming in at a much faster rate, higher levels of multi-customer relationships. Look at that. I should highlight more. Perfect. So all that's very exciting. I'll also bring it closer just in case anyone's having some problems seeing. If you guys are on mobile, which I didn't realize how many of you guys actually are until I saw the statistics, you can always zoom on the phones if I'm zoomed or if I'm too far away. Just pinch that screen. You can make the numbers real big. Now, what happens whenever a bank, which will be SoFi quite soon once they're actually profitable and start to make additional money and are growing customers at much faster rates? Remember, SoFi wants to bring on 1 million new customers per quarter, not 86,000, okay? That I do believe will happen. SoFi's the future. But that being said, capital deployed here. Common shares have gone down drastically since 2016. Imagine what a growing stock does whenever you go from 484 million shares down to 300 million. You're dropping your overall shares by like over 33+%. Like, that's incredible. That growth alone is just from good capital deployment. And then also the dividends on the other side. You're also getting paid to hold those shares, which then you can have, dripped back into your account. And then that also adds to your growth in your account. So like, this is the beauty of buying banks early on, is that you're getting these stocks for discounts before all of the institutional buyers like Warren Buffett come in to buy this stock in later stages. Remember, Warren Buffett is a holder of, actually, is he still a holder of Ally Bank? I think he actually might have sold out. Someone in the chat, please let me know. Go check the 13F. I think actually he did trim his position. But idea being that you don't have to, those large investors don't have to wait, or sorry, they will wait to get a good hold on some good bank stocks. That could be very similar with SoFi. Just because we don't not seeing value investors coming in now does not mean that they won't later, right? We just started bringing on the ARK Invest, investors. Give some people a little bit of time. But yeah, essentially, those are some of the fun things that I saw. It's exciting to look at Ally, but like I said, who said it? Chris said it perfectly. It's a 45-year-old man in a 20-year-old club. I still am not a fan of it because I do believe that the large amount of people will transition to the younger style of banking. And of course, I just closed my DFS page right before clicking over. That being said, if I remember correctly, Ally stock did do quite well, up 5% today on those earnings. So good for them. If you hold Ally, please let me know why you're holding it versus, just holding SoFi. I'd love to know. Okay, I'm getting up DFS right now. This one, I don't have nearly as much to talk about. But it still is interesting to go through. Let's take a look at some things. Where is it? This is not the page that I was expecting. Did I jot my notes down wrong? Did I jot my notes down wrong? Okay, let's just move on to this then until I find what page it is. So DFS, by the way, did not see as good of earnings this time, not nearly what Ally saw, and now it's getting people a little worried. See, this is what happened last year too. There was like bank earnings. Everyone was doing so great. And then Lending Club showed off their numbers, and then people went, oh no, SoFi is going to have bad earnings. But no, really, it was Lending Club was the outlier, not SoFi. So just because one company is not as healthy as the others does not mean that SoFi is necessarily doomed, but it is good to look at their performance. So a couple of things that people originally saw, okay? Capital position in terms of CET1 ratios, we talk about this every single day, has been dropping. In the market that we're going into, it's not exactly what you want to see. Now, they did say, I don't want to jump right into Outlook. Let's go take a look at some of their performances. I know that they were showing off. Is this the page I meant to get? Page 5? Sure. Okay. Net interest income drivers. So this was a couple reasons why the stock started dropping, okay? Net interest margin on their loans actually went down. This is historical compared to the other banks. This was not seen from other banks. Most of the time, their net interest margins were actually going up, but it is because cost of funding is also going up. A lot of these banks to compete to get more deposits in are offering higher rates to get those deposits in, which lower those margins, okay? Essentially what those margins are is how much can you charge for yield for those products versus how much you actually have to pay, and then also minusing out what's your chance of default. Okay, that being said, DFS, if you guys don't know about them, or the Discover card, obviously it's the large percentage of their overall portfolio, which cards grew by 19% year over year in terms of their loan portfolio. Organic student loans grew by 3% this quarter. It's quite exciting, I guess. Sorry, that being said, whenever we actually look at personal loans, this was quite exciting, 27%. Same thing with Ally, right? The personal loans did better than people thought. I'm sure there's a large need for personal loans with debt consolidation, things like this, because interest rates are still high. What does SoFi do best, right? That's going to be quite exciting. If, for example, we sell loans, the only thing that could get us into some heat for SoFi is if we don't sell loans. We're bringing on this huge mass of new personal loans and everyone wants them. And in every article that you guys go to shows SoFi has the best loans on the block. You're going to want to make sure that we're not overselling loans. Now, obviously, if it becomes anything like that, where too many people want our loans, we can instantly... there's so much flexibility with banking. You can either offer it to the best clients, raise the yields to sort of stunt out a lot of those customers, or you just keep selling. A lot of flexibility with banking. But still, interesting. Total loan yield was up 11 basis points quarter over quarter, primarily due to higher prime rates. partially offset by higher interest charge-offs. Yeah. Okay. This is exactly what Vadim said on Twitter, is that this is probably almost definitely going to show that the percent of charge-offs, or the percentage of loans that we're going to necessarily probably not see some money back, okay, will probably be higher than what we are expecting for Q2, even for SoFi, right? Across the board, it's usually an industry thing. But that being said, really what stunk for Discover Financial Services was their outlook. Okay, there was a lot of things here that people didn't like. Operating expenses, for example, are expected to go up. This is what they were saying before, expecting total operating expenses to be up less than 10% from prior year. Now, this time, expecting total operating expenses to be up to low double digits from prior year. What was exciting, net charge-offs, which is not good, before was expected to be at 3.5 to 3.8. Now it's only 3.4 to 3.6. That's actually a lowered guidance for net charge-offs, which are bad. Now let's get into the really bad stuff. This is what shareholders hate, ladies and gentlemen. $2.7 billion of share repurchase plans authorization expiring June 30th, 2024. Now they're pausing. Now instead, they're going to pause their share repurchases, which means the capital appreciation on the stock is not going to be as fast. And in fact, people pulled out. If you're not going to give us our fake dividend, then we're going to leave. So there was let me find it here. Repurchase. Okay, here it is. I guess I just passed it. If we look over on this side for a capital return, you can see that in 2021, they bought $2.3 billion worth of shares back. Next year, 2022, $2.4 billion. This year, only 0.7. Okay, that was expected to be 2.7. So continuously beating those margins, right? Pausing it entirely is a super scary sign, because there are certain investors that will look, especially for dividends, for example, where they'll continuously look for not just holding their dividends, but increasing them. They want to make sure that 2.3 to 2.4 to 2.7 was the trend that was expected to happen. If you're cutting that again, it's going to look a lot like 2020. But there might have been a reason to stop in 2020. I don't know if there's as much of a reason in 2023. Whenever you're sounding the alarms and the other banks really aren't, you kind of got a little bit of a problem. All right. Went a little long this episode. I'm not done yet, but I did have way more to cover. So it might go a little bit long, but I just have so many good things to cover. So, Toast. Let's talk about Toast. Yesterday, a large investor, Josh Brown, a CNBC commentator and CEO of Ritholtz Wealth Management, never heard of them, stated that they doubled their position in Toast stock. He said, Toast has the potential to be one of the great growth stocks going forward, but today the stock dropped by 16%. Nice pump and dump. I don't actually think it was him pumping and then dumping. I did originally, until Toast actually updated their website here. They said, update on Toast digital ordering for customer communities. Or community. To our customer community, after extensive discussions with many of you, we have made the decision to remove the 99-cent order processing fee from our new version of our digital ordering suite by the end of the week. So they put this out. The stock ran up because there was going to be a lot of profitability priced into this new offering. And then, obviously, they took it away because customers were probably very upset. And I'm sure if you're doing a stunt like this, there was definitely churn, okay? Which means people got off the platform. They could have went to Square or something like this to go elsewhere in the restaurant business. There are a lot of competitors. So making a large move like this not only puts a bad taste in the mouth of customers, because not only they tried to sort of run this sort of shady practice, although it didn't even work out and they rescinded it. What are they going to do next, right? Now you're a company that's showing off that you are hungry for more profits. You're willing to sort of change your pricing policies in order to sort of not take advantage of us, but to to increase your profit margins. And there was such a backlash that they completely removed it, which then put a bad taste in the eyes of the investors, knowing that you're not going to stomach up and you're not able to put out new products that actually monetize the systems where it doesn't upset the customer, right? That's one thing. Like Netflix, for example, just actually showed off their numbers today. And one of the things that I'm not a fan of Netflix, okay? I don't like the pricing model, everything like this. But one thing I got to give a ton of credit to Netflix is they'll make large changes. Like the change whenever people went from, family account sort of ideas to no password sharing, anything like this. Then they ran that in Canada and they said, hey, you know what? The churn actually was non-existent. Funny enough, I was password sharing on Netflix. They canceled it. I didn't sign up. So it wasn't from customers like me. I just stopped using Netflix. YouTube has gotten way more in my business. That being said, that ability to hold in customers while changing your pricing is a big feat to how strong your brand is, right? I'm not actually a big fan of Netflix. I find the price very expensive, considering how much of the overall like global population you have and how much the competition, like whenever you originally got into the business, there was no one else and you had this massive first movers advantage. And now there's a ton of people coming out with their own content. And now you're seeing things like all those strikes that are happening with different actors and writers and these sorts of things, which is all going to bring down your pricing if you're Netflix. It's not my favorite business at all. But that being said, for the like it's got to be priced as if it's a dividend paying company and not a growth company, because you're definitely hitting that sort of end of your S curve. Now, if they're able to change their monetization, I know we're a little bit off fintech, but if they're able to change their monetization in a way where they can continue to keep customers, potentially you could actually get into ads. There's a lot of other ways to monetize hundreds of millions of users, but it's just a matter of people won't get upset if you completely change policy like that. They have tried that with basic policies, these sorts of things, partnering with Microsoft. But yeah, I don't know. I think there's just so many clear investments. I don't know about you guys. Like SoFi to me is such a slam dunk. The only thing that I wanted to talk about that I was looking into today for SoFi was those credit card charge-off rates. They are, they're gross. They're high. Tanner, you're one of the few people who can make banking exciting. Thanks, Doug. I appreciate it. No, but it's true, though. There's a ton of money in banking. Like, everyone says, oh, it's all boring banking, okay? It's like, sure. You want the benefits of what Warren Buffett does, but you don't actually want to be invested in those style of companies. Fintech is the perfect place for me, where I know that the end game is so unbelievably profitable. Everyone needs it. The audience that needs banking is actually growing and drastically. There's 75% of the overall population of the planet is underbanked right now. Okay. Give credit to all those people. You're going to see a large increase in the amount of money that can be distributed, and payments will be a big part of that. I think that global payments will always get larger and larger and larger. The exciting part about banking as well is that before, whenever it was sit down sort of, branch banking, that there was a little bit of a problem with how far people were away from branches. There was a problem with you can't see multiple people for their financial needs at the exact same time. Digital is a completely different space. You can reach everyone all instantaneously. You can have that branch-like relationship with your bank where it's still personalized and custom to you, but yet you can be going anywhere in the world. You could be traveling to Spain and still be talking with a mortgage broker, for example, which might even be a AI system, and still get personalized financial advice. It's incredible. We're mixing two amazing platforms right now are two amazing investing styles of extremely high profitability in banking, reliable, good capital management, willing, like very easy for large investors to trust banks because they understand capital management much better than other styles of CEOs. And then you also have the large growth aspects of so many customers don't even know that their products exist yet, and there's still a large shift over to there. I don't get how people don't see it. That it blows me away. There's like two big industries. I mean, there's way more than that. I shouldn't even say that, but I find the shift to EV makes a ton of sense, and then the shift to digital banking makes a ton of sense. And I do think that SoFi and Tesla will be these two sort of big companies that take just a huge margin. PayPal's going to continue to survive and be their own sort of big giant. Square, by the way, I need to do a video about Square soon. That company is undervalued. Don't listen to Steven Fiorillo. I'll have him on with all this new stuff that I found. Get my shovel out. I'll have to bury him in the argument. But Square, really, really excited about Cash App. They are going to be cracking down on expenses over at Block. It's all they're talking about is hiring freezes, getting more efficient in their things, lowering expenses for all sorts of employee activities like travel and everything like this. It's not a lot for a business, but it adds up. And that sort of tightening of the, of that sort of expense is good. You don't want to be frivolous with your growth. And for the longest time, I think they were. We have to remember how many people use Cash App. It's an unbelievable amount. The growth only gets higher with these types of products. Average revenue per user grows. And let's not forget about Nubank as well. Nubank, I'm going to be putting out a video on Nubank. If you thought the live was a deep dive, I'm talking like a nice deep dive on Nubank for why I'm believing in this company. That'll be coming out soon, along with some conversations with great investors that I've had recently. I've got another one tomorrow, so quite exciting. Cut the CEO salary. Well, you know what? Nubank did that, so it's definitely possible. I don't actually think Jack Dorsey pays himself all that much, and I don't think that their stock-based compensation is out of whack, especially Nubank's. Like, guys, there's not a part in that company that I don't like, and that's why I think large investors are also liking Nubank as well. Crazy, crazy. Thank you all. Appreciate it. Come back tomorrow for more deep dives on different stocks. Look forward to seeing you guys again. Hopefully you enjoyed the Ally and Discover Financial Services breakdown, along with maybe some burnt toast. Are you guys buying?